Inventory is a crucial asset for any business. It is described as the array of goods used in production or finished products that a company maintains throughout the normal course of operations. Inventory can be categorized in 3 different ways, including raw materials, work in progress, and finished goods. In accounting for inventory, there are special considerations that should be well thought out to better understand how inventory is properly accounted. Generally, the legal title passes when the possession over the goods is transferred. There are several circumstances, nonetheless, in which the transfer of ownership or control does not also involve a transfer of physical possession. As a result, control may be transferred even before or after the transfer of physical possession. Regardless of location, an entity must include in its financial statements all inventories for which it has acquired legal ownership or control over the associated economic benefits. In this regard, the following should be properly taken into account: goods in transit, consignment, inventory under financing agreement, sale with unusual right of return, sale on trial or sale on approval, installment sale, bill and hold arrangement, special order, and layaway sale. Mike is a direct seller of various kinds of gadgets and electronics. A buyer, named Max, who plans to resell, placed an order. After packing, Mike then delivers the goods to the carrier for shipment to the buyer. If both parties agree that the sale term is FOB shipping point, then ownership over the goods is transferred at the point of shipment. Max then records the purchase and accounts payable upon shipment. Hence, at this point, she then became the owner of the goods. However, if the sale term is FOB destination, ownership over the goods is transferred when it reaches its destination. In this case, the goods in transit still form part of Mike's inventories, since the goods are not yet received by Max, who is the buyer. So, Mike will only record the purchase and accounts payable when the goods are received. There are different terms for shipping costs that may be contained under a sales contract. These terms include freight collect, freight prepaid, free alongside, ex-ship, CIF, and CF. Under freight collect, freight is not yet paid upon shipment, meaning the carrier collects shipping costs from the buyer when the goods are delivered. Therefore, the buyer is the one who pays for the freight. However, this does not mean that the buyer should be the one to pay for the freight. Another term is freight prepaid. This is the exact opposite of freight collect. Under this, the seller pays the freight in advance before shipment. But this does not mean that the seller should be the one who is supposed to pay for the freight. Next is FOS, or free alongside. A seller who ships free alongside must bear all expense and risk involved in delivering the goods to the dock next to or alongside the vessel on which they are to be shipped. This means that the buyer is the one who pays for loading and shipping costs. The title only passes when the carrier takes possession of the goods. There is also a term called ex-ship, wherein the seller assumes all expenses after the goods are unloaded from the carrier, at which time title passes to the buyer. It is also possible for a buyer to pay in lump sum the cost of the goods and the insurance and freight costs. This is called CIF, for the cost, insurance, and freight. Under this, the seller must deliver the goods to the carrier and pay the costs of loading. Thus, title passes to the buyer upon delivery of the goods to the carrier. But as a general rule, the entity who owns the goods being shipped should pay for the shipping costs. Mike noticed that Max is excellent in reselling the gadgets. So, he offered Max to enter into a consignment contract. A consignment contract involves a consignor who transfers goods to a consignee, who acts as an agent of the consignor in selling the goods. In this case, Mike is the consignor and Max is the consignee. Consigned goods still form part of Mike's inventories and are excluded from Max's inventories, since she does not own the goods. She is merely selling the goods on behalf of Mike. Therefore, when Mike delivers the goods to Max, Mike still retains ownership over the consigned goods. Hence, it is still part of his inventory. Memo entries are only prepared since ownership of goods are not transferred between the parties. The freight and other incidental costs of transferring consigned goods to the consignee form part of the cost of the consigned goods. Repair costs for damages during shipment and storage and other maintenance costs are charged as expense. Max is entitled to a commission in every item she sells. She recognizes it as her income, while Mike recognizes the commission as an expense. Then on, Max would deduct the commission she has earned from the amount she remits to Mike. A day later, Mike convinces his friend named Arthur to purchase a computer for his shoe store business. Arthur is still unsure about this, so Mike gave him a week of right of return, hoping that Arthur will keep the unit. Unfortunately, after it was delivered, Arthur found out that the computer is defective, and he now plans to return the unit to Mike. In this case, Arthur does not recognize the ownership of inventory. This is called a sale with unusual right of return. Goods that are purchased are usually recognized by the buyer at the point of sale. But in the case of Arthur, since the computer is defective, the purchase does not qualify for recognition as asset. A buyer does not recognize any inventory if the buyer assesses that no economic benefits will be derived from the goods, such as when the goods are defective or unsaleable, or the buyer intends to return the goods to the seller within the limit allowed under the sale agreement. After returning the defective unit to Mike, Arthur, the owner of a shoe store, made his way to the bank to borrow a large sum of money to further finance his business. However, the bank requires a collateral before proceeding with the loan. Since Arthur does not own any asset which can be used as a collateral, he decided to enter into a product financing agreement. He went to Luna, the owner of Super Shoe Company, to negotiate. Arthur proposes to buy 10,000 shoes from Luna, and at a later date, Luna would have to purchase back all these shoes from Arthur. Under the financing agreement, Luna does not ship the 10,000 item shoes, but instead, she gets to retain it at her warehouse. Despite the fact that Arthur does not physically have the ownership of the shoes, technically, he has the title to the shoes, hence, he can now use it as a collateral to make a loan from the bank. After getting a big loan from the bank, Arthur then takes part of the loan to pay Luna for the shoes. Later on, Luna would then fulfill her obligation to repurchase the shoes. The proceeds from this would then be used by Arthur to pay back its loan from the bank. Basically, the accounting for a product financing arrangement is to treat it as a borrowing arrangement and not as a sale transaction. This arrangement does not result to the transfer of control over the asset. Therefore, Luna, the seller, retains ownership over the inventory and continues to report its ownership of the asset sold, as well as a liability for its repurchase obligation. After some time, Arthur manages to grow his business, but with the aim to finance his business operations more, he decided to take a loan from the bank again. However, unlike the last time wherein he entered in an agreement with Luna to provide a collateral for the loan, he now owns lots of inventories that he can use as a collateral security for the loan he is about to make. To borrow a large sum of money, Arthur went to the bank and pledges his inventories to secure a loan. The ownership of the inventories is retained by Arthur, since this arrangement does not result to the transfer of control over the asset. Moreover, under this arrangement, a third party, for example, a public warehouse, holds the inventory and acts as the bank's agent. The public warehouse then furnishes the bank the warehouse receipts, evidencing rights to the inventory. Despite the success of the business of Arthur, he still encounters seasonal sales slumps, late invoice payments, sudden equipment breakdowns, and other circumstances that is beyond his control. Due to this, to protect his reputation and avoid disappointing customers, he decided to borrow inventory from his previous associate, Luna. Arthur borrowed 1,000 footwears from Super Shoe Company and promised to replace it with the same kind of products. The inventories borrowed by Arthur from Luna will be included in his inventory, since under this arrangement, the control over the asset is transferred to the borrower, which is Arthur. After some time, Arthur managed to maintain the success of his shoe business. As a reward to himself, he decided to purchase a brand new car. He went to Tommy Motor Company to find a suitable car for his everyday endeavors. Upon looking, he couldn't decide what car to purchase. So, the seller of the cars allowed Arthur to use the car he had chosen for a given period of time. In this case, the car in the possession of Arthur is still owned by the motor company. Hence, the ownership of the car and risk of loss is still on the seller. The legal title over the car delivered to Arthur becomes his only when. First, during the given period, he became satisfied with the car and decides to purchase it. His approval or acceptance of the car must be known to the seller, or, second, when he retains the car beyond the time fixed without giving notice of rejection. Thus, when the goods are not returned within a reasonable period of time after the trial period has elapsed, the good will be considered sold. After using the car for a few days, Arthur became satisfied and decided to purchase it. The next day, Arthur also decided to purchase a delivery truck on installment. And so, he went back to Tommy Motor Company and picked the best one. After deciding which is which, Arthur made his first installment payment. Through this, the possession of the goods is transferred to him at the beginning of the installment period. Despite possessing the delivery truck, the legal title over it still remains to the seller until the selling price is fully collected. Hence, the delivery truck is still owned by the motor company and is still included in its inventories. However, recording the installment sale as a regular sale is also an accepted accounting procedure, wherein the sale involves a deferred income on the part of the seller and a regular purchase on the part of the buyer. Therefore, in such case, the goods are excluded from the seller's inventory and included in the buyer's inventory at the point of sale. Tommy Motor Company was leading the market recently due to its expanding business. And so, due to its growing sales, the owner, Tommy, decided to place an order for more raw materials from his supplier, Billy Automotive Parts Company. But due to an unprecedented breakdown of one of Tommy's factories, it resulted to a delay of his production process. This led to lack of storage for his pending order of automotive parts from Billy. Because of this, Tommy has requested Billy to temporarily retain the raw materials until Tommy solves his storage problem. Billy has agreed and Tommy later sent his payment. This kind of contract of sale is called bill and hold arrangement. Under this, a seller bills a customer but retains physical possession of the goods until it is transferred to the customer at a future date. Take note that under bill and hold arrangement, the goods are excluded from the seller's inventory and included in the buyer's inventory upon billing, if the following criteria is met. The reason for the bill and hold arrangement is substantive. A substantive reason may be that the customer lacks storage capacity or its production schedule does not require the goods until a later time. The goods are identified as the customer's asset. To qualify as the customer's asset, the sold goods must be stored separately and cannot be substituted for identical goods. The goods are ready for immediate delivery to the customer. The goods must be completed, packaged, and ready to ship. There must be a fixed and reasonable schedule for the delivery of goods to the buyer. The seller cannot use the goods or sell them to another customer. To meet this criterion, the seller cannot have the ability to use the product or direct the product to another customer once the product is sold. The success of Tommy's business has attracted more customers to try his brand. Tommy has received a special order from one of his customers. The customer wants to order a customized car which requires specifications. A special order is typically performed when a customer wants to purchase an item that is not currently available in the seller's inventory. The item may be a customized item or it is out of stock and unavailable for any reason. A special order item may be any saleable item from the store's inventory. When an item is out of stock, the buyer cannot take possession of the item immediately. The seller needs to manufacture it first. When the special order item is finished, it is shipped to the buyer or the buyer is notified to pick it up at the store. Take note that a special order typically requires deposit or a full payment for the item before it is processed. Therefore, special orders are segregated goods from the seller's warehouse, making it part of the buyer's inventory when it is ready for delivery. After half a year, the special order item is finally finished and ready for delivery. Therefore, at this point, it is no longer part of Tommy's inventory. After a while, Tommy started to manufacture a top-of-the-line car model. Only a limited number of this car model will be manufactured. Tommy decided to only sell this car either under a full payment of a layaway sale. Under a layaway sale, the buyer makes a series of installment payments and the goods are delivered only when the buyer makes the final and full payment of the product. Don't be confused, as this is different from a regular installment sale wherein goods are delivered to the buyer at the time of sale, which is discussed earlier. To better understand, the goods sold under a layaway sale are included in the Tommy's inventory until the goods are delivered to the customer. Delivery is made after the final installment payment is paid. However, when significant payments have already been made, the goods may be included in the buyer's inventory, provided that delivery is probable. If the customer does not complete the purchase, then Tommy may be allowed to either return the customer's payments in full, retain the payment entirely, or return the payments minus a fee depending on the terms of the contract. A layaway sale is particularly useful for lower-income customers who may not have sufficient funds to pay for the full amount of a purchase at one time. All of these are the special considerations that should be taken into account when accounting for inventories. As a summary, remember the following. If the type of arrangement is free on-board shipping point, the goods are included in the inventory of the buyer upon shipment. But if it is under free on-board destination, it remains part of the seller's inventories until the goods are received by the buyer. Whereas under consignment, the goods are owned by the consignor still, although it is in the hands of the consignee. As for sale with unusual right of return, the buyer recognizes the goods purchased at the time of sale, except when the goods are unsaleable. Moreover, under inventory financing, the goods are to be included in the inventory of the borrower. While, for sales on trial or approval, the seller retains ownership until the buyer approves and purchases the goods. Additionally, under installment sales, bill and hold agreement, and special order, the inventory shall be included in the inventory of the buyer. And lastly, as for layaway sales, the seller retains ownership until the buyer makes his final installment payment.